Welcome to Global Insights with me, Punita Kumar Sinha. Today we focus our attention on China and the impact it has on the global economy and markets. China, the world's second largest economy, is slowing, and people are worried that this is a structural slowdown. The economy is rebalancing from being exports-oriented to being more domestic demand-driven. Wages are going up. Does India stand to benefit from this? Mark Mobius of Templeton is joining me to discuss just that. But first, a quick look at how bad things really are in China. Nikhil Shivadas has this report.
The dragon seems trapped. On the one hand, export growth is stagnating at around 1% for the current year because of the global financial crisis. And on the other hand, China has not been able to create significant new consumers within its own boundaries. The result? Slower investments, high unemployment, and slow economic growth. China's manufacturing output is at a 9-month low, and its GDP growth is at 7.6% year-on-year, the lowest since 2009.
Monetary conditions have remained tight for too long. I think the authorities have underestimated the extent of the slowdown. I think that's one very, very important factor. Secondly, you've had continuing declines in fixed asset investment, particularly from central government, and they've kept the reins very tight on expenditure.
The construction sector, which accounts for more than 20% of its GDP, has slowed down too. According to the IMF, a 1% decline in China's real estate investment would shave off 0.2% of China's real GDP within the first year and have negative spillover impact on its G20 trading partners, which in turn would result in global output loss of 0.06%. A slowdown in China's real estate sector also has a cascading impact on consumption in several sectors like consumer durables, energy, metals and capital goods. There is no doubt that government spending needs to rise and domestic demand has to be revived. The government realizes that and has returned to pro-growth reforms, and Chinese interest rates have been slashed twice in the recent past.
We think that the turn to more growth-supportive fiscal and monetary policies in China are bringing about a strengthening of domestic demand, and we certainly see that in the public infrastructure investment numbers. So we think the second half of the year, and particularly the fourth quarter, we should see higher growth, bringing us to full-year growth of 7.8% in China for 2012, picking up to 8.3% in 2013.
A fiscal stimulus seems like the need of the hour, but the government seems reluctant about it because it could be inflationary.
The authorities there have been reluctant to do too much this year because of the need to work out some of the issues that resulted from the previous round of stimulus following the global financial crisis. So there's been a reluctance. That means the scope for a really meaningful stimulus set of measures, a stimulus package, is a little bit more limited.
The reason China is important to the world economy is because not only is it the world's largest manufacturing hub, it is among the world's largest consumers too. So what can one expect in the near term?
What we should expect is a very significant slowdown in investment expenditure in the Chinese economy, to the extent that investment could even be contracting over the course of the next 12 months, and that will weigh very heavily on GDP growth and the economy generally.
This means that things could get worse before they get better.
Pro-growth reforms are necessary for China to maintain its winning streak. But will China be able to pull it off? Joining me on the show today is Mark Mobius, Executive Chairman of Templeton.
Thank you.
Mark has spent over 40 years studying different emerging markets. So much so that he's known as the father of emerging market funds. Mark, talking about China, its real GDP growth is at a decade low, other than the 2008 blip. Should this concern global investors?
No, not really, because China is still growing at a very rapid rate for an economy that size. You must remember now, according to economists around the world, China is the second largest economy in the world. And when you have an economy that size, you cannot expect continuation of the double-digit growth that they had during the past decade. But we can expect high and middle single-digit growth, which is what we're looking at this year, probably about 7% growth. And that is very healthy growth for an economy of that size.
It appears that China's leadership is prepared to sacrifice growth at the expense of rebalancing the economy from being export-oriented to consumer-oriented. But, it's the data showing that things have been cooled off too much. Mark, what do you think needs to be done to resume growth?
Well, I believe that they still want high growth because they are worried about unemployment. You must remember China is producing lots of graduates from universities and schools that need jobs. So they have to ensure that these people find work, and that means a fast-growing economy. But I believe that the shift from export orientation towards domestic consumption is a very healthy one and positive for the rest of the world, because it means that China is going to become a big importer, a bigger importer than it is right now. We've seen imports by China now taking up something like 9% of the world's imports, whereas 10 years ago it was about 2%. So this is a very, very healthy development for everyone concerned. Now, how are they doing this? They, of course, have to provide more and more wages, higher salaries. And we've seen very, very rapid increases in wages in China. In many countries, we've seen maybe 3 or 4% or even no growth, whereas in China, we're seeing 20% growth in many areas in wages. So they are definitely moving in the right direction. There is a safety net problem with China, as you know. They need better hospitalization, lower cost hospitalization, pension funds, all of these things that make people feel secure so that the money that they earn they can spend. Nevertheless, the consumer market is growing at a very nice pace.
Is it still likely to be the world's largest economy by 2020?
Oh yes, I think definitely can happen. The U.S., as you know, is growing at a pretty slow pace. It depends on what happens in the U.S., of course. If there's tremendous change and reform in the U.S., then U.S. can get up to higher single-digit growth, and that, of course, would change the picture. But as it stands now, China definitely can reach that goal.
Mark, now a question related to the Chinese consumer. I believe that U.S. exports to China have risen over 500% over the last 10 years. Can China's consumer economy power global growth in the next decade? Can it fill the void created by the slowdown in consumer spending in the developed world?
I don't think China can be the engine that the U.S. is at this stage of the game anytime soon. It'll take time for China to be that engine. And I don't think it's in the cards for China to be the engine. U.S. will still be important. Don't forget Europe. Even though Europe has problems, they are still constituting a very, very big economy as a group, and they will continue to be very important. But then you must consider India. India is also growing at a fast pace, and India will become a much bigger consumer market going forward than even China because of the young population in India. So we look forward to seeing India having faster reforms, faster change, so that this will take place. And of course, infrastructure is the key issue here. Not only in China. China also still has, despite all the government spending, major infrastructure problems. And of course, you know that India does, particularly in the power generation arena.
Low wages have been the key to China's success, but it urgently needs to build up its domestic consumer base. And that can only happen if wages rise. We are taking a short break now, but stay tuned to find out the impact of rising Chinese wages on the global economy. Welcome back. You're watching Global Insights with me, Punita Kumar Sinha. I'm still in discussion with Mark Mobius of Templeton on the slowdown in China. Now, Mark, Chinese wages have been going up, and this could reduce China's competitiveness. Imports of cheap Chinese goods have actually helped moderate inflation. So should we worry that rising Chinese wages will be inflationary for the rest of the world?
What China is doing now is moving into automation, into higher value-added products, into very sophisticated products. And that's where the future is for China. They have to move up the value chain to more value-added. And I think they will get there. It'll be very spotty because there's certain parts of China in the interior where labor rates are still very cheap, and where many factories have moved, by the way, to take advantage of that labor rates. But since the Chinese government wants this to be a consumer economy, those wages are destined to move up, and therefore they will become less competitive in the high labor content arenas.
Mark, now shifting on to commodity prices, what do you think will be the impact of China's slowdown on the commodity prices longer term?
There's no question that the slower growth in China will mean a cutback in imports of various raw materials. But you must remember that a lot of this was overdone. When China needed more and more raw materials, there was too much stocking taking place. A lot of minerals and other commodities were imported and stocked. A lot of inventory. Now these inventories have to be worked down because the demand is slower, and therefore you're seeing the knock-on effect in exports from Australia, from South Africa, and other places. But I think this is temporary. You must remember, a country that's growing at 5, 6, 7% still demands tremendous amounts of raw materials that they don't have and they have to import. So this definitely is a temporary phenomenon. We believe that commodity prices will continue to trend upwards. And then don't forget, it's not only about China. It's about India. It's about all the other countries in the world where more and more demand for power, for all kinds of goods and services is increasing.
As you know, for strategic reasons, the Chinese have been buying natural resource assets all over the world, particularly in Africa. And this has been worrying policymakers globally. What is your view?
I personally think it's a very good phenomenon, because the more that the Chinese get involved in investments in other countries, in Africa, in Europe, in the Americas, so forth, it will be very good for world peace. The greater the degree that the Chinese have a commitment to other countries in terms of their own investments, the greater the chance that there will be a more peaceful world, in the sense that a growing China, a more powerful China, has to be harnessed in the right direction towards more peaceful enterprises. And of course investments, foreign investments, overseas investments will do that.
Will it create a risk of supply for countries like India?
Yeah, there will be some risk there, because some of the investments the Chinese have made are dedicated to be exported to China. Even if they say this iron ore or this coal mine is dedicated to only China, well, the other miners will have to find a market, and those products from those other mines will find their way to India.
Today, China holds